Hello, buddy. LA here. This is the weekly review. U.S. markets, it's July 19th. This is for the week of the 17th. Let's get started. If we look at the numbers, what did we get last week? Not a big surprise. Finally saw some selling take place in that NASDAQ NDX complex. Well overdue. I mean, these things have been going up vertical, right? And so now we're starting to see some selling there, which is what you would expect at some point. Question is how does this play out now? Do we see the NDX NASDAQ just crumble? In other words, did we have some sort of a push up that was unsustainable that's just now going to give it up? Or are we just seeing what looks to be rotation because we saw money moving into the S&P 500 and into the Russell? Still saw support both in all the bonds in the gold market and the dollar still starting or continuing to sell down. A dollar's been on this selling mode for a while now, and it's actually it's not to the point where it's worrisome, but it's to the point where one needs to notice. Okay, so rotation. We're seeing money flow into the S&P 500 swing point high here, and we're right at the top trying to break out. Tested it twice, actually tested it 3 times in the past 5 sessions. On the other side, we saw this big push on the NASDAQ NDX and then a sell down, right, that same day, that reversal. That was this same day here on the S&P. S&P claws back up, NASDAQ can't. So far, to me, this looks like healthy rotation. And to support that, if you look at the S&P, both on the both of these being on the daily time frames, right, daily here and there, you've got these ABCD structures pointing to 3307, 3247. That's about 2.5. This one's just 0.75% higher. And so these markers are up here are go-to targets on these ABCD structures inside. And so this, as long as these continue to fulfill, these are bullish, right? And that's been what we've seen for quite a while and continues to be what you have to expect to continue until it changes, right? In other words, if the trend is up, you just got to go with it. And right now, that's what we see happening. Weekly, they're even higher. 7.5% for the lowest, 15 full percentage points for the highest one. So if we were to make it up to the highest, it'd be 37. The next target on a weekly is this a smaller one sitting up at 34.65, which would be pressing new highs. If we're going to see something change that's negative, right, you got to start seeing failures, right? So the unhealthy case would be failures, right, where you don't expect them. In other words, we just are sitting here trying to break out. Let's assume we break out, we go up and hit that target 32.47. Now we get a retrace because that's the normal thing that should happen. You get a breakout, you should get a retrace most of the time. You get the retrace, and what happens? You get a push back to where it is and a retest, or not a retest, but a regenerate back to the direction of the trend. That's what's supposed to happen. But what if that doesn't happen? What if we actually come to the bottom of the swing point high and we break out and we break to the downside? Right? That would be a failure. That would say what's up is probably sideways. That's the sort of thing that needs to start happening if we are to assume that this market's not going to continue going higher. But as long as it keeps doing what it's supposed to do, then you just got to stay with it. You got to assume it's going to continue. Same thing over here on the NASDAQ, right? The NASDAQ really should not come back to retest regen again. In other words, here's the swing point high, breaks out, right, pushes over it, gets the retrace, here's the test, and now it's up here hanging and it wants to try and regenerate higher. Now it can hang up here for a while, that's fine. You really don't want to see a second retest because your odds shoot down to something like, I don't know exactly what it is in this particular case, but maybe 42% or so. And so it's a less than a coin flip that you're going to hold. Where's the hold? Bottom of the swing point high. So if you were to crash underneath that, that would be something unexpected, right? And that would say that what's up, probably sideways. Now that, if you go back and look at it, that is what happened back here, right? But then what did it do? It shot out and broke a swing point high here, right? And that changed it. Okay, so the sideways didn't last very long. Matter of fact, didn't last but another couple bars, but that is, again, proving that this thing is stronger than you think, right? So that's not what was supposed to happen. It wasn't supposed to go back up and break higher. So if we see that, in other words, we've already seen one case of it down here at this particular case, right, where we broke the swing point low. If we do it again, that's two occurrences, right? You have to start thinking, well, you know, maybe this is really starting to get tired. Doesn't mean it's going to crash or anything, but it does mean it's getting tired, and that means that maybe that rotation is really going to kick in. And that's the sort of thing where you have to judge, because if it only happens here on the NASDAQ, doesn't happen on the S&P, when this break here took place, S&P didn't do it. And so you only saw one of the indexes. You need to see them all if you're going to believe, you know, that, you know, you need congruence across all the indexes, and that it's not what happened back there. But if you start seeing it here, then maybe that's just that rotation where you're moving out of the NASDAQ, the NDX, and moving into the SPX. And that's healthy. That's not bad. As a matter of fact, if you go back here and look at this swing point high, that test was on slightly less volume. That was to be expected that it would try to regenerate. Okay, we've covered this before. I'm just going to point it out one more time. You know, what is it that keeps this market going up? I mean, we look out there and we see all this stuff happening, and it's like, seriously, how can this continue to work higher? You know, there's a synchronized world recession going on. There's massive hits to GDP worldwide. There's central bank debt creation like crazy. The GDP debt ratios are insane. The massive unemployment stateside and to some degree worldwide, declines in world trade, all these things are negative, right? Over the long run, these are bad things. Yet on the positive side, right, you've got these huge government interventions, the likes of which we've not seen before, right? We've seen $3 trillion in the government giveaway so far, and there's another $1 to $3 trillion coming by the end of this month, supposedly. These are massive, you know, redistributions of debt to individuals. On the government side, I mean, on the business side, there's these huge government grants and some free money that's being given to support artificial demand, right? I mean, so all this stuff together is huge. And then you've also got, and I probably should have put it here too, but you've also got the central bank doing its QE and supporting these government giveaways and loans. $3 trillion in just QE, and there's the potential that they're going to grow that even more. So this keeps the market going. You know, these things should be negatives and bringing the markets down, and this in fact is bringing the economy down, but it's not bringing the market down because of all the distribution of government subsidies and QE. What's going to end this? You know, we've got this leg going higher. I mean, if you look at the charts, you know, the charts have been staggered, but they essentially, and this is like a weekly chart of the S&P and the NDX. And, you know, the NDX has already made new highs. The S&P is trying to get to the highs, and it's almost there. It's only like 3-4% away. And so when you look at this, right, it's like, what's going to stop this? When is it going to end? You know, where is the peak going to be? And to me, it seems like it's one of two flavors that it would happen, right? Either the free money, which we just talked about, just disappears. Let's say that they being the Congress and the administration, can't come to an agreement by the end of the month or shortly thereafter to extend these programs that they have out there and to initiate new ones to create more artificial demand, right? Either they seriously curtail it or it just disappears. That could create this type of top, right? This this expectation that things keep going up all of a sudden disappears. The other thing that could happen is that this continues, right? And this market goes even more vertical. I mean, it's vertical enough, but it could go even just vertical as you can imagine, right? And just straight up. And then what you would see in this case, if it really is a blow off top, in other words, it reaches some pinnacle and then just blows off, you'll see a huge spike in the volumes at the top. And then you come off hard, right? Very fast, heavy move to the downside. And that would probably lead to some sort of a failed bounce, which would lead to a big decline. That, to me, one of those two situations, right? The money just disappears or seriously curtailed and the market just slowly grinds and rolls back over, or you get some sort of a blow off top. But those could be a long way away, right? It could be before, it could be after the election, it could be a year from now. You don't know. That's why you follow the trend. That's why you wait until you see evidence, right? You need evidence that something is happening, right? You got to have short-term failures. And when I say short-term failures, if you want to get down, look at it on a 30-minute chart. I publish the 30-minute chart every day because I use it as a guide for my own trading. If you start seeing failures on a 30-minute chart, then you see it on the daily chart, then you see it on the weekly chart. If you get out to here and you start seeing failures, then you've really got something big happening. But until we see it, right, there's no evidence to support it yet. There's nothing tells us that it's done. So you just got to assume it's going to continue until you start seeing failures. What do we see now? This is more of the fundamental type stuff. You got all these earnings coming out. Last week was the first big batch of them. You didn't see the particular companies trade that much higher. Than a lot of them sold off. Some of them actually bumped up. We saw financials, healthcare, transports, and durables mostly last week. And in general, all of those sectors, they moved higher on the week, right? Healthcare is up big, and transport's up big. Durables, financials just a little bit less. The numbers, right? They sucked. I mean, these earnings are terrible, right? But the guidance is so terrible now that they quote unquote beat. Isn't that a surprise? That's just the way it always is. Next week, Tesla, Amazon, Microsoft. These are the big three heavy caps, especially Tesla. This thing's had a huge run up. We'll see how the earnings play out here. We'll start to see tech earnings. We haven't really seen this yet. And if the tech earnings really disappoint, right, then we may start to see a huge, fast rotation out of tech, right? Because tech is driven this market all this year. Pandemic shutdowns, opening pauses. Something like 80% of the states where the population is, where most of the population is, this is happening, right? They're either rollbacks or they're pauses, but it's happening. But you know what? It isn't happening in effect. There's no effect, right? The market doesn't care. Now, maybe that's because they know it's going to force Congress to hand out more money, right? The markets are perverse. They'll look at bad news and take it as good. And that's just the way they operate. And if they look at this and say, well, you know what? It makes this more likely, therefore, market's going to go up. And maybe that's just the way it is. Or maybe it's just, I got no place else to put my money. I'm just going to keep putting it in the market. We are seeing some evidence of small first-time traders, retail traders, piling into things. Right? Both in terms of the number of accounts that are being opened, in terms of the amount of margin being used, all those kinds of things. And that could also contribute to like an NDX type blow off, right? Where we see this reach its pinnacle. But that's hard to gauge, right? That's just it's like sentiment numbers. It tells you that, things are happening that are probably not good for the market long term, but you don't know where that top is. But so far, all of this bad news is just getting the markets revved up even more because it's causing those things that are keeping the market up. It's causing more of that to happen. Economic data, there are no real no surprises, retail sales, beige book, all that stuff. Yeah, it was horrible, but it was better than expected, right? It's just the way these numbers work. Expectations get set so low, and then we beat them. Fed is next week, not this coming week, but the week after. And the market fully expects that the Fed put is very much alive. In other words, anything that shows weakness in the market is going to cause the Fed to come out and support it. Political timetable for more bailouts, 2 weeks into this month. What's the bottom line? Same thing it's been, folks. Nothing in the charts to suggest this market's going to pull back yet. It will come at some point, but it's not there. I don't see it. And until we start to see those failures, like I pointed out on the dailies, then you just have to assume it's going to work higher. Last week, tech did sell down, but that was rotation, right? Just went elsewhere. Didn't exit the market. We didn't see the general market. In other words, go back to that first chart. S&P goes higher, NDX goes lower. That's not congruence. You need congruence. You need both of them to go down if you're really getting some sort of a sell-off. That's rotation is what we saw. Until we start to see these technical failures, we've got to assume the market just goes higher. Last week, it was the most likely scenario, test of a June highs that holds. That's what happened. What do I think the coming week? I think you're probably going to go up and try to hit those ABCD structures on the like 3250. It looks to me like that's what's in store. Best case would be pushing all the way up to close that gap. Worst case would be a full retest regen off this swing point high. Would be the second test, and that potentially could lead to a failure. But those are kind of the three scenarios. And I expect this market's going to get over the swing point high, go up, hit those targets, and then try to retrace and regenerate one more time. That's where we're at. Have a great one. Take care. And here's the details. I'll see you next time.